the executive editor of BQ Prime. If you're into the stock markets, you need no introduction to this man, Niraj. It's usually you on the other end, and like this would feel a little different.
Me and my CEO were discussing that our goal is to make a million millionaires. I think India has already done that, but this seems to be a term which could actually create a lot of wealth, and Indian retail investors should participate in it. Started ET now, and then when Bloomberg Quint happened, started Bloomberg Quint, which is now transitioned into BQ Prime. So it's been financial journalism for the past 19 years. They also realized how to choose the better end of the mutual fund basket available.
They wouldn't feel like you made any money from the stock market, so you should leave it to the experts.
Every Diwali, I write an article called 10 Things That I Learned About Investing in the Previous Summer, right? All through the last few years, I've written that. That's got some great nuggets about investing.
Before I begin this podcast, I have a small request. If you've ever found value through this podcast or the other videos that I've been sharing on this channel, please do me a small favor. Please hit that subscribe button, like the videos, leave a comment, hit the bell icon. If you have any questions that you'd like me to ask to the next guest, please let me know in the comments as well. I would be happy to help you. It would mean the world to me if you help me grow this podcast, and I promise to bring on more guests to bring you more value. Now, back to the podcast.
In this episode, we have Niraj Shah, the executive editor of BQ Prime. I mean, if you're into the stock markets, you need no introduction to this man, Niraj. It's usually you on the other end, and like this would feel a little different. So thank you for coming on to this podcast. How are you doing today?
Very well. Thank you for having me, Aakash. And I look forward to the next, 30 minutes, 1 hour, however long it takes. It's lovely to be talking to you.
Yeah, I'm going to pick your brains and understand how you think about markets and essentially provide value to the end viewer, like how they can start investing. And yeah, so before we do that, Neeraj, can you give us a little bit of your background, like for the few people who don't know about you? Like, can you tell us your story? Like, how did you get into the markets and how did you get started, first of all?
So technically, I'm not into the markets per se. You could argue because I'm into financial journalism, yes. So we report a lot on the markets. But yes, not technically as investors are who invest or who have an AUM and put others' money to work. We don't do that. But to cut a long story short, I did my B school sometime in 2004, and after doing a job for gold and dollar trading for about 9 months, CNBC TV 18 happened to me back then, and since then, 3 years out there, another 8 years in ET now. We started ET now, and then when Bloomberg Quint happened, we started Bloomberg Quint, which is now transitioned into BQ Prime, and that's how. So it's been financial journalism for the past 19 years.
That's a lot to chop it like in different segments, but like I'll try to be as quick as I can with all the questions. Before I do that, like I'll have to make a quick disclosure. Like this podcast is only for educational purposes. Whatever discussion that we are having about stock markets is only for educational purposes. Please do your own research when you're investing. Neeraj, right off the bat, like the market has run up so much. Like even the top guys sitting, like the biggest investors, they might be thinking like, hey, what's going on? Like, can you give us some idea? Like, how do you see the market right now?
So it's a tale of glass half full or a glass half empty, Akash. And if you look at the very near term, you could argue that maybe there is a case built up for looking at the glass which is half full, but one should not ignore the glass half empty rather. But one should not ignore the fact that the glass is half full. And I'm talking about a very short term. So I'll explain this to you, right? I think if you look at the better part of this decade, going ahead, over this, which is what you could argue a long term now. India looks very solidly poised. Almost every company, global in nature, every fund manager, every global fund manager, everybody talks about how they want a slice of India. If they have an existing slice of India, they want to increase that slice of India. So with that as a backdrop, I'm bringing this so that people don't misunderstand what I'm about to say. But with that as a backdrop, the near term then comes into the picture. In the near term, you could argue that the broader end of the spectrum has run up quite a bit. I mean, you look at various ratios. You look at, so for example, if you look at the market capitalization of the large cap names versus the mid cap and the small cap names, and compare to the profit pools that they have, right? And typically they should match. But in this case, as we stand currently, the profit pools of the mid caps and the small caps are lower than their market cap representation. So simple that they've run up a bit, they could come correct a bit more. Now, whether this can happen today, next week, next month, next 6 months, I have no idea. Because the markets may remain quote unquote insane for a lot longer than you can remain liquid, right? So there is a case for a correction, Akash. I don't know if it happens, and I have learned very early in my life that predicting the markets is a mug's game, so I'm not going to attempt to do that. But there's a case for mid caps and small caps, select pockets to correct because they've run up too fast too soon.
But isn't it good? Like there should be a correction that's good for the market.
That it hurts people who get in last, and historically, retail always used to get in last. The beauty about the last 4 or 5 years, Akash, is that if not directly, then through mutual funds, retail has consistently bought into the markets through the SIPs and the mutual fund schemes. And that's very heartening. So this time around, the retail wealth correction, when it happens eventually, may not be as severe because the MF flows will remain steady. The only caveat, of course, is that a large portion of our volumes of late, Akash, are options. And there, what happens is, to be honest, anybody's guess. I don't think anybody's a clear answer of who is winning, who's losing in that game.
Yeah, you said about mutual fund inflows. Like, are you looking at any interesting data points that you can share with your viewers?
So 2 or 3 things, actually not 2 or 3 things. I mean, just plain vanilla. If you just look at any monthly data that you pick up now or over the last 3 years, right? Every monthly inflow data that came in, there used to be vagaries around what kind of funds, etc., have gotten more share, less share. Small cap funds got a bevy of inflows, etc. What remained constant was the SIPs. And to my mind, that's the only data from a retail investor's perspective worth considering. I mean, frankly, Akash, it's heartening to know all through the better part of the first decade of the current century, or for a better part of the second decade as well, we used to lament the fact that the Indian markets, which are always look promising, were largely owned by foreign institutional investors, and Indian people never used to own it. I think that has changed through this mutual fund investment route, right? Because retail now owns a large slice of the Indian markets, and one only hopes that as the economy moves up, Indian retail doesn't lose the faith.
Yeah, but like when you talk about mutual fund inflows, the SIPs have remained the same, that have consistently grown. Like majority of those mutual funds, the top holdings that they have exposure to the large caps like HDFCs, Infosys, TCS. Majority of them, their holdings consist of that. And those large caps are lagging in this bull run. Do you think like we could see some sort of negative returns on those mutual funds, and that may inherently like reduce the sentiments of the current inflows of SIPs? Do you think that could be a possibility?
So, okay, there are 2 answers to this, Akash. The first one is that large caps, in select cases like banks, for example, you rightly pointed out, for example, HDFC Bank or a Kotak Bank, etc., they've lagged. And large caps per se have lagged the mid caps in the recent past. I don't think that data necessarily holds true for the slightly extended time frame. Part one, I don't have the numbers at hand. Sorry, I didn't kind of look at those numbers. But I think if you look at the last 12 months data, then sure, or the last 6 months in particular, SMIDs have really outperformed the large caps. It may not necessarily hold true for the slightly longer period of time, but that is one aspect of this. But 2, you got to compare what you're choosing against, right, Akash? I think a lot of investors who come into the markets in the last 4 or 5 years have graduated from keeping their money in a safe, savings account. Now, with time, I think everybody will also realize that if they can spend time, of course, on this, they'll also realize how to choose the better end of the mutual fund basket available, cyclical, structural, thematic, so on and so forth. Or if you're parked into large caps, does it make sense to actually look at the passive funds versus the active funds, especially the large cap category, mind you. I'm not talking about flexi cap or multi cap or mid caps and small caps here, only talking about the large caps. I think people will learn that. It would be wrong for people who have straight away come from, into the large cap arena or the equities arena without spending time to start expecting great returns from day one. You got to give a little bit of time to this. And to be honest, when you're starting off, even if the relative returns are lower, the safety of the large cap end, the predictability there, the liquidity there, though I think even the mid caps are now a lot more liquid, but all of that is probably good for a starting investor to be parked in the large cap end, even if it is not performing as well as a flexi cap or a multi cap or a small cap fund. In my personal view, of course.
Yeah, that makes sense. But like, to segue on this, like there's a whole different market going on in the IPO markets, right? There is so much euphoria in that market, like an issue of 9 crore, 10 crores that has bids of 2,700 crore. That's like, you can't even quantify if this is rational or is this even sustainable. What do you think about that? It should be, and more importantly, there are people coming into the markets that have no experience. They are buying into these IPOs and they may have had some luck in their IPOs and in allotments, and they expect that these are the kind of returns that you can have in the stock markets, while they have no experience of the real returns that we see of compounded 20-25% on a 10-year period horizon. So any thoughts on that?
Always happens. Happened in 2007, just before the crash, happened in early 2008 or thereabouts, has happened midway through the last, in the last decade as well. In every cycle, this will happen. In every cycle, I mean, okay, here's the deal, right? Somebody was telling this data to me yesterday. I don't remember it exactly, day before yesterday, actually. Is that if you look at the 52-week high and the 52-week low difference in the micro cap index, I think the number, and I'm not 100% sure here, but still telling you what I remember, the low is 100 and the high is 300. So there's a wide gap between what's happened at the broader end of the spectrum, right? So anybody who's made money in the last 12 months, believe me, Aakash, or not anybody really, but a lot of people who have made money, they might start thinking that they're very smart, right?
Yeah.
But it's the market itself has done really well. So if you threw a dart, it would have made you money. That's the limited point, right? That stock would have made you money. So it's very easy to get carried away. It happens in every cycle. People will get invested into some IPOs, some of whom are very good, by the way. There are some very promising names which have come out with IPO, and some marquee investors having invested there. I kind of have a sense of what the story of these companies are as well, right? Because you talk to the investors, you talk to the companies. You have a sense. Some companies are really good, but you will have some of these things. It happens every time.
And then how do you put a picture in terms of, hey, this, like you said, like there are really good companies. How do you identify like these are really good companies? Like if I put in some chunk and I get allotted on that IPO, I should stick to that instead of like cashing out on 100-200% return.
Yeah, actually now it's very easy relative to what it was maybe 20 years ago, and even more easier than what it was when even I was not in the market, but other people were investing, right? Because the flow of information was very limited. Nowadays, you get a fair degree of information flow from watching interviews that happen not just on our platform, by the way. Every other platform does a good job. So my colleague Sajid does this IPO Adda, but that's just a limited part, right? I mean, the basics, stick to basics, read the annual report, look at what is it that the management has said in year one versus the previous year, if that information is available. The DRHP usually is a gold mine of information, but frankly, I mean, even I don't look at the DRHP when I'm doing it. Utna time nahi hota hai, and I can understand even retailers might not have that much time.
All right, Niraj, let's talk about, we talk about how the markets are working, how people should be investing into the stock in the IPO markets. Let's talk about somebody, sorry, who has no idea about the stock markets, but doesn't want to take too much risk. They have some understanding of how the financials work because they read some books, watched some videos, and they want to get started on this journey. What should their thought process be like? How should they prepare? How should they like get into the markets essentially? Should they do a direct route or should they choose an indirect route from mutual funds or ETFs or anything like that?
Okay, now if you can't hear me, you can stop me midway, okay? But my firm belief is all of that depends on the quantum of time that you are going to be able to give to investing, the process. Now, if you can give the time, then it's good to have a mindset which says that I will look at direct investing and I will learn it until such time. Let me try the mutual fund route, if you will, or small cases as the case. Maybe there's some fairly good small case options there. But if you believe you can give yourself time or give investing time, then go ahead this route, have this mentality of trying to study companies, eventually investing yourself. If not in year one, then year 3, year 4. You do learn if you give time. But if you are of the belief, and a lot of people might be there who say that, okay, I have a well-paying job, I have a career in front of me, which will give me good money, but I also want to take advantage of investing, but I know I can't get the time. Then frankly, it will do you a world of good if you leave that to the experts, funds, small cases, even PMSs if you have a lot of money, right?
Yeah.
And earn the moolah which you can invest through these people. It's a much better route.
Right. So that's the route.
Sorry,
Like
I
what?
have a reason. I have a reason why I'm saying this, Akash. If I can take 1 more minute here.
Yeah, sure.
In the current times, nobody will quite realize why. It's okay. From March 23rd, 2020, largely the index has kind of been higher. People have largely made money. There have been no large drawdowns that people have experienced from that point of time. But if you've seen other previous cycles, there are a lot of choppy moves, right? And it's very easy to say that we will ride it. But if you are parked in one or two wrong stocks, and if those stocks correct 50, 60, 70, 80%, you might leave the market altogether. And that's not a good sign. You need to be in the markets, especially in the Indian markets, which are likely going to be benefiting, likely going to be very strong over the course of the next decade, if you will. And therefore, the first thing is to plan so that you don't leave the game. Now, if you believe you will not leave the game despite the corrections, if you are in single stock investing, and if you can give it time, then by all means, that could be more rewarding. Otherwise, fun.
Yeah, that's coming from somebody who has seen that cycle. Like in 2017, we saw how much euphoria there was in small and mid caps. I was still new to the game. Like I was trying to invest in like small and mid caps. My allocation was wrong at that time. I'm going to say it honestly. Like I put in a few large chunk of money in a small cap that went dirt, like Mandana Retail. I'm going to say it honestly. There was a company that there's Mandana Retail. They had this distribution franchise of Being Human. Then I tried to contact them like, hey, what's going on in the back end? They didn't respond. So that really, although the other stocks that I had in my portfolio, they were doing fairly well. They gave me returns of 20-30% annually. But because of this one stock, my entire portfolio level return was really bad. So yeah, you said it right. Like you should, there would be chances that one of your stocks would go down 50-60% and then your returns they wouldn't feel like you made any money from the stock market. So you should leave it to the experts.
Quick one. If you haven't subscribed to this channel yet, please do so. Your support is the only reason that I've been able to have all these incredible guests on my podcast for trying to bring more value to you. So please do me a favor, hit that subscribe button, like the videos, leave me a comment, hit the bell icon, save the podcast, share it with your friends, whichever platform that you're consuming this on. And yeah, that's it. Back to the podcast.
I think so too. And imagine, Akash, I presume from what you are doing, you're telling me that you were a full-time investor back then. And still you suffered the fate of Mandana Industries, right?
Yeah.
People who can't give time won't even know what went wrong with the portfolio.
Yeah.
And that's why.
Yeah. And okay, that's the approach that you need to have. Like, what about, let's say, a person who is willing to take that risk? What should be, let's say, a perfect recipe of becoming a successful investor? And so that even after they go through this phase, they are able to come out stronger.
So everybody will go through that phase. The best people get it wrong. But if your basics are correct, Akash, and it's an easier thing to say and difficult thing to do, but investing is as much art as is science. So you got to master both in order to be successful. So the science part is well documented. I mean, there is enough information available now. You can learn how to read balance sheets, etc., to ensure that you don't have time bombs in your portfolio. But having said that, while the science part is done, and that is so important, the art of when is it that the cycle in some stocks is turning, and mostly stocks are cyclical. There are very few which are very structural movers in life. Mostly stocks go through cycles. It'll do you tremendous harm if you bought a really high quality stock at the peak of the cycle, right? Because then your returns might not happen, even though the company is brilliant for a number of years. It's happened to Infosys, it's happened to HUL, happened to many other firms, right? So you want to be careful of that as well. But just the basics of ensuring that you don't look at just the PE multiple and say that, okay, if the PE is good, then everything is okay. It's the easiest available form of ratios, and therefore even we financial commentators, when we talk to companies, talk about PE all the time. But the more difficult work, you look at the cash flows, you look at the balance sheet, all of those things are just so important in order to get the art correct, and by the use of science. So that, to my mind, is very critical to ensure that you don't lose too much money, and when you're making money, you actually beat the benchmarks, if you will.
Yeah. But in a way, isn't that timing the markets? We talk about like we shouldn't time the markets, like including myself, I've done it. So in a way, that is timing the market. You're waiting for a cycle. You're waiting for that, some time that there's some good news flow in that sector or that company, and then you put in your like whatever money that you're trying to invest.
So yeah, so I completely buy your point, Akash. As for the retail investor who is investing in mutual funds, they should not be thinking of timing the market, because you can't time the market. For people who are doing direct stock investing, not understanding the business cycle and going out and there and saying that I will buy this stock and then I'll hold it for eternity would not be the greatest of ideas. I mean, if you bought into specialty chemicals, let's say in 2017, if not 2013, and if you didn't get out at the peak sometime in 2021, then your stocks could possibly have been down 50% from the peaks that they made, while other stocks are moving higher. The question is, would you be able to tell yourself then that, it's okay, I don't want to time the market, so I'll hold on, nurse my losses, and stick to these stocks while I watch some of the others move up? That would have been wrong. You bought into the, how do I say, the internet companies, right? When they listed, you still not out of the money. But if you waited and if you understood what's happening around, and if you then happen to buy, just using an illustrative example about a Zomato at 50 or a Paytm at 500, so on and so forth, you are right now not licking your wounds, but making hay while the sun is shining. So I do believe in individual investing. Timing is a very important very important ingredient.
Yeah, that's true. Okay. Now, what about people like I said, like some people have not experienced the downturn, and they are going to see that downturn in the next couple of years in some sectors, right? And they'll experience failure in their investments. And maybe if they don't have the right risk management, they'll feel like the market isn't for them. And we're going to see it collectively in terms of a whole lot of people, and then that may affect the market sentiments as well. How can somebody who is like actively investing right now be prepared that there will be a time that I'll face some sort of capital erosion? So how can they minimize their capital erosion, and how can they make sure that their capital allocations is in a way that would sustain that downturn?
I mean, this is the crux of it all, right? And there are no easy answers here, and different people, I mean, there are 1,000 ways to skin a cat. The way I would think of it is that in any cycle, wherever there is euphoria, try and take some chips off the table. I mean, if businesses are looking like they are grow for the next 10 years, but if the valuations are extremely expensive, try and take some chips off that table if you don't sell the entire holding of a stock, to prepare for buying the same business maybe when there is a downturn, because there will be a downturn. It always happens with every business, no matter how strong it is looking. So that's part one. And part two, it's usually during a downturn that you look at past history and try and take solace. So any downturn that you look, and I don't think anything could have been worse, to be honest, in recent living memory than COVID, right?
Yeah.
I mean, we've had demonetization, we've had something else, but COVID, the world was shut, and we recovered from there. So if you look at past history, and if you simply draw a 10-year chart of the Sensex or the Nifty, or the mid-cap index, or the small-cap index, or whatever you like, a basket of high-quality stocks, if you have the skill to be able to chart them, and if you see what's happened to them during a downturn and then the recovery, and then eventually are they higher 5 years out, the answer in all probability is a yes. That should give you some idea of, at least, Akash, for the next 10-15 years, what could be happening in India. Beyond that, who knows? But right now, as things stand, from whatever is visible, from conversations, from the money that is looking to come in, so on and so forth, things look promising, and therefore people should keep the larger picture in mind, that what could potentially happen X number of years down the line, and therefore, instead of getting scared away, is this the time to take advantage? But you can only take advantage, conversely, when you've taken some chips off the shoulder of the book at a point of time when the valuations were sky high. So kind of marry these two things, and usually you will be not too disappointed, I think.
That's a great advice. Okay, follow-up question on that, Neeraj. Like, you have had the chance to speak with some of the best investors in the stock market. You spoke with Rakesh Jhunjhunwala. You've spoken with Vijay Kedia. I mean, a lot of them. I could name a handful of them. But if you could remember one story with any of the investors, like you found that, hey, this is the one of the best life lessons or investing learnings lessons that I've found from this person. Can you tell us some of that? Can you tell us a story that you could share with your audience? Like, this is something that non-negotiable when it comes to investing.
So I won't name the person because I've
Yeah,
learned
sure,
multiple people, right?
Yeah.
And actually a shameless plug, Akash, if you will. But every Diwali, I write an article called 10 Things That I Learned About Investing in the Previous Samvat, right? So all through the last few years, I've written that. That's got some great nuggets about investing. So frankly, I may not be able to recollect everything. But if you ask me one thing, not as a non-negotiable really about investing per se, but a way to look at things, right? And hear me out, I'll maybe make a couple of minutes. But one of the guests had told this to me when I had asked him about the mindset that he has when he has to book a loss into a business or into a stock, because you don't get everything right. So how do you, usually people fail to accept that, oh, we got it right. So they keep on averaging at lower levels and don't pyramid at higher levels, right? The basic policy of a mistake that people do.
Yeah.
So I asked this gentleman about what does he do when it comes to this. And he told me to think of replacement as an argument to enact that move, wherein he said that you invested in stock A and stock A has corrected because maybe the market has come down. You got to examine the reasons why it has come down. Of course, if there's an issue in the business, then this is not for him. But if the market has come down, if there is a healthy correction that has happened and all stocks are down and your stock is down 30%, you refuse to maybe book profit losses because you think, how can I do that? It's a personal defeat. But then you look at something else that has also corrected 30-40% maybe. You always wanted to buy that business, but you couldn't because the valuations were high. And one way to kind of clean up the mess in your portfolio, correct the mistakes in your portfolio, is book the 30% loss and buy into an attractive business, which also may be down between 25-30%, if you will, because you're getting it cheaper than what you otherwise would have gotten it had you bought it at X point of time a month or 2 months before. And that, in a way, as a mental model, works beautifully, because otherwise people just find it awfully difficult to book a loss and say, oh, I got this loss in my portfolio. It's just difficult to accept it. This might be a great mental model or a way to tell yourself that, hey, it's okay to do it because I am investing that capital into the business. The other small thing that I can actually add to this, Akash, is that to my mind, the buying price of a stock from the minute that you bought it is irrelevant.
Yeah.
But you ask me why, and I'll tell you why. Maybe you know the answer, but for the benefit of the listeners, I'm telling you why. 2 months out, if the stock that you bought it, let's say you invested 100 rupees in a stock and you bought 100 units of that stock. So you've invested 10,000 rupees in it, right?
Okay.
And let's say the stock doubles in about 3 months' time. So therefore, not unheard of in the current circumstances. So your capital is 20,000 rupees. Now, it doesn't matter whether you made 10,000 rupees profit or that your cost was 100 rupees. And why? Because what matters is at the current point of time, is the 20,000 rupees that you have ideal to stay invested in that stock, or can you invest that 20,000 rupees into some other business? Similarly, on the losing side, you bought a stock 200 rupees worth, 100 units, 20,000 bucks. It corrected, it's gone down to 100 rupees. So you have 10,000 rupees worth of that stock. The question you got to ask is not that, oh, I bought it at 200, will it go back to 200? No, the question you got to ask is that this 10,000 rupees that is there with me, is it better to be in this stock, or is it better that I put that money in some other stock? I think once this people imbibe in their investing journey, a lot of stocks that people hold on because they've gone up or because they've gone down will get corrected. Ask yourself, where is the capital best suited?
Right. So you need to think in terms of from your growth perspective. A lot of people, including myself, I'm not going to say that I've not done it. Like, we are attached to a stock. We don't feel like exiting from that, even though, although obviously if it has done good, we don't want to give up on that stock. We want to let it run. So we kind of have that attachment with the stock. And even though we spot an opportunity, we don't know if it's going to continue going up, the stock that we have found, that's a new one. So how do you differentiate, like how do you get unemotional with terms of your stock and like understand, hey, this is a better opportunity that you can look at in terms of your growth and in the next 10-year horizon?
The marriage of art and science, Akash, what I said earlier. So if you've done your homework, no, really, but it is as simple and as complicated as that. I think you will be able to understand a business only when you've married both the science and the art, right? If the numbers are saying that this is great, if what you feel about the cycle of the business or the sector is telling you that this is looking great, then you might be able to take a call. I mean, a lot of businesses would have corrected in 2021. You might have been able to get out of those businesses even if they were great companies, or even if they are great companies, but if the cycle was bad, only if you told yourself that, hey, this is a great company, I understand, but this money is better suited. For example, I mean, at any point of time, if you bought an internet business in the last 6-7 months, or if you bought, you know, an auto business at the start of 2022, you would have told yourself that at this point of time, whatever capital I have into, let's say, maybe IT companies or large cap IT might be better suited, let's say, in autos. It's not that IT companies are bad. It's not that auto companies are better than IT companies. It's just a question of being able to identify what might do better. And that is a factor of valuations, business cycles, so on and so forth. So marry the art and the science. That will give you the answer. If you don't have an answer to this, then mutual funds is your route.
Yeah. Okay. Here's last question in terms of mindset, then we'll go to strategies. When you speak of market psychology, like there are a lot of factors you need to look at. You need to look at things from the sector's point of view, the stock's point of view, the management. There are so many variables when it comes to investing. How do you read market psychology from your experience? And I mean, there are different perspectives. I speak with a lot of investors. They share their perspective that, hey, the market is unemotional. That remains constant. But beyond that, there are a lot of variables. Like you need to look at, some people have this, I have this analogy that I need to look at it from a sports angle. Like just like sports, you look at teams, right? Which team is doing better? So how do you read market psychology? And like, what are the key takeaways that you have taken from your experience? Like, these are some things that I always look at when I'm investing.
So if I understand your question correctly, you're asking for what aspect of investing would you consider the most important from a mental model perspective? No.
That's the second point. Okay, you can say that. But what is the what are your key takeaways from your experience? How do you read market psychology?
Yeah, so I have the advantage of, Akash, being able to speak to some of the best investing minds, and therefore it's a lot easier for me to grasp what some of the best thinkers in the game are thinking about the market at any given point of time. The standard disclaimer is that most people have gotten it wrong once a year, twice a year. It's just a difficult piece. Like I told you at the start of this conversation, it's a mug's game to try and predict what the market will do tomorrow. I know we try it every day on the shows as well, but I, for one, don't try and predict what will happen with the Nifty, because I frankly don't think it's possible to do that. At least I don't have the ability to do that. If other people have, good luck to them. And there are some people who probably do it better than others, so good luck to them, but I don't. So to my mind, I mean, when I look at whether there is a probability or higher probability of there being a scare or there being an upswing, so on and so forth, it's a factor of what some of the best minds are telling me about how they are thinking and the points that they are looking at. A lot of people look at the open interest existing on the index market, or the rollovers that happen on the futures and options side at the end of every expiry. A lot of people at times look at the kind of volumes that are happening at the broader end of the spectrum. Recently, there is a lot of conversation about the options volume to the cash volume ratio comparison of India versus the rest of the world. There are multiple ways, really, and there are multiple data points. It's too confusing at times. For my mind, to my mind, it's always been, is the market trading at above standard deviation valuations is the flow of money, which a lot of people scoff at, but I don't. But is the flow of money looking negative or positive? And post 2020, Akash, to be very honest, I think it's also a factor of what central banks are saying. You have to admit that every rally or every fall that we've seen since COVID lows has been a factor of what central banking action has been. And that's a big brother and a big gorilla out there, a big elephant in the room. You can't really fight the big elephant in the room. So rather take cues from there and try and maybe size your positions accordingly, even if you don't capture or even if you don't bet the whole house on either direction.
Yeah, I mean, that's true. Like we move in the direction of where the central bank heads us. Okay. Neeraj, when it comes to strategies, there are so many strategies in terms of investing. There's like indirect investing, but let's talk about direct investing. Predominantly, we hear two types of investing. One is value investing and the other is momentum investing. What do you think which one is better?
Well, if I told you value investing was better, you will cite data from maybe 2018 onwards for a better part of even last year and tell me that, hey, this went completely wrong. But I would believe, so if you can find value in growth. Simple, right? And therefore,
aren't they expensive though?
Yeah, but so that's the limited point I'm making, that okay, here's the deal, right, Akash? Look at it this way. Some of the best companies, and until a better part of 2020, maybe even after that, growth at any price used to get the favor, right? Because money was available cheap. Now that money is expensive, interest rates in the US too are at the levels that they are at, and money is expensive, you suddenly find there's a mixture of growth and value, classically divided into both, right? You look at growth, look at value, and both of them periodically are doing well. To my mind, you can protect your downside by investing smartly in value. Now, that doesn't mean that everything that is cheap is valuable. So not everything that has perceived value is valuable to invest into. But if you take care of making sure that you're not buying things or investing into things when the valuations are way off the hook, then usually, even if you don't get dramatic stratospheric upsides, you will not get severe downturns.
Right.
They may be downturns and they may correct, but it won't be severe because, the simple thing of risk reward. The one thing that you learn beautifully from technical analysts, although I profess complete ignorance about that profession despite 18 years of being in business journalism, is that they look at what is the risk, what is the reward. You will never hear a technical analyst say that my stop loss is 30% lower, but my target is only 5% higher. It's a mug's game to try and enter into that trade. Simple. Yeah. Similarly, if you buy a stock at 70, 80 PE, it may do really well. It may grow at 50%, 60%, 70% for the next 2-3 years, and the stock may still do well. But the probability of the market getting disappointed at the first sign of trouble is so high that you're running a high risk unless you understand the whole cycle completely, right? And if you don't, then look at value investing. I prefer, I've seen usually, Akash, that people who invest into businesses which are growing at a good pace, but also are bought at sensible valuations, typically have a better sleep in the night and also make money. And I think that's a proper combination.
Yeah, I mean, like, yeah, you said that you can look at value and growth, and maybe there are actually good companies in the stock listed space that you'll find that even have like a good dividend yield that you can like look at an alternate of a fixed deposit. The only problem that I see from that is they have run up so much. The P ratio is so high that you feel like, hey, if it doesn't make sense that you buy at that price. So that's a game that you have to play.
A higher P ratio and a great dividend yield won't coexist. So that won't happen. But typically, I think off late, the dividend yield investing used to be such a hot thing, Akash. In a few years back, off late, there are very few investors that I speak to who say that, oh, I'm buying this stock because it's available at a fantastic dividend yield. Sure. There are gray-haired investors who do it on their own. They run maybe a 25-50 crore portfolio, personal investing is great. But I don't hear a single PMS manager, a mutual fund guy, or at least a PMS manager who tells me that I'm buying this stock in my portfolio because it's giving me 6% dividend yield. That doesn't happen. But typically, a high PE stock will not be a great dividend yield stock, simply put. So that won't happen. But yeah, even that strategy is okay.
Right. And from your experience, Neeraj, like what's your risk management like? Like what do you recommend that people should be looking at when they invest, and what should be the risk management they should be sticking at? Is it just simple percentage wise, or do you have any models that you can share with your viewers?
No, I don't, but I've spoken to a bunch of people who've told me different things about how they manage risks. So there are some very smart investors who understand the game so well that they hedge their portfolios via options. And options is a bad word these days by virtue of the fact that the volumes are sky high. But there are people who do it really well. They have a stock in their portfolio, they're running leverage portfolios, and then they also write options. But it's a high risk game, but they manage it that way. And there are other people who ensure that no matter what happens, a stock, no matter how strong the growth story is promising or looking, doesn't exceed 15% of their overall portfolio. And in some cases, even 15 is very high. I mean, mutual fund investors, of course, will go that much also. But I'm saying PMS investors or private investors, they kind of ensure that it stays up to 15%. If it goes beyond 15%, then even if the management is shrieking that we are going to grow 100% for the next 3 years, these guys take some chips off the table. So there's some people who believe in percentile allocation as a risk management tool. And some people also look at the sectoral allocation that they've done very, very carefully. They do not, no matter how promising multiple companies in the sector look, they do not let the overall sectoral allocation go above a particular limit. And I think there is merit in that because like I said, everything goes through cycles and therefore it's wise to kind of limit exposure there.
Makes sense. Okay. The next question, Dheeraj, I'm going to make it as simple as I can. I'm going to ask in a way that everyone can understand. How do you value a company when you're trying to invest?
Well, the simplest, like I said, the most often used metric is a PE multiple. And it's not a bad starting PE multiple, Akash, let me tell you that. So if somebody doesn't know anything, you can look at a PE multiple. If the PE multiple seems very high, and if it's not accompanied by growth targets, then yes, the company is expensive if the PE multiple are. It's simple, right? Depending upon industries or sectors, there are other multiples to look at. And so if you're looking at a cement company, EV EBITDA or EV per ton is a much better metric to use as opposed to PE multiples. In a commodity company like metal companies, for example, the PE won't be the right metric as opposed to EV EBITDA. Because you've got to at some point of time capture the debt cycles or the debt levels that these companies have, and therefore the EV captures that. So look at those multiples in select sectors like commodities, for example, where an EV EBITDA would give you a far better and a more relevant idea about whether the company is expensive or cheap. Now couple this basic things with whether the company's leverage ratio is very high or no. And if you have some more time, try and look at the free cash flow generation that the business is doing. Try and look at the working capital cycle that the business has, if that is relevant for that business, and in manufacturing businesses it is. And if these things work out together, then even if you bought it not at the bottom end of the cycle, but bought it while the cycle is coming down, but you bought in a quality company, and at some point of time it will reward you, because you won't be able to catch the stock at the bottom every time, right? I just want to make one more thing clear when you're talking about it. When I said about timing, I didn't mean that you will be able to sell the stock at the top and buy it at the bottom. I'm just saying align your investing in a way that the probability of that is higher.
Right. And as you said that if you look at a commodity company, you need to look at these metrics. And you also mentioned about debt. What, according to you, is the ideal metric for, let's say, a steel company that has debt? Because you don't know if that company is over leveraged, somebody who is very new. So what should be the ideal metric that you need to look at in terms of debt, that if this company makes sense? Let's say, I'm not going to name any stocks, but let's say there are a lot of steel companies in Nifty 50 that are doing good, but they also have huge debt. So how do you identify that these are okay companies to invest and make sure that I'm not putting in too much capital into that individual stock?
So one, debt by itself is not bad. In fact, not having any debt in the businesses that you spoke about, infrastructure or steel, is not possible. Two, is not ideal. I mean, debt is tax beneficial, right? So it will be foolhardy to fund everything with equity and a large equity base as opposed to also smartly utilizing debt. So that is part one, just a small caveat there. Having said that, in the case of commodity companies, I mean, so let's say 1:1 debt equity is ideal for most companies. In the case of commodity companies which are into capex heavy businesses, you could give a little bit of leeway. Let's say the debt equity ratio goes up a bit more. That is fine. Look at the acceptable levels of debt equity that the sector as an average has. Look at the kind of cash flows that the company is having and whether it can service the kind of debt. Also look at why is it that the debt was taken in the first place. In a lot of cases, the debt is taken because the company uh, believes, or even you believe, that there is an upcycle coming and there is a capex that the company has put up, and their expanded capacity would help the company go out and generate cash flows and profits, which will help reduce the debt at some point of time and expand profits meaningfully. And therefore, it might actually be a good thing. So debt equity ratio, I mean, usually the ballpark that most people talk about is 1:1. I would say in commodity companies, slightly higher. But also the soft skill of figuring out why is it that the debt was taken, and does that either capex or something else that the company took the debt for, or an acquisition that the company took the debt for, is it meaningfully going to alter the picture of the company?
Right, that makes sense. Okay, Neeraj, this is a generic question, but like I'm going to make it. A lot of people who are starting the investing journey, they have this question that how do you read a balance sheet, right? They don't have too much knowledge of finance. They don't understand metrics. So what are the key important metrics that you look at in terms of investing when you're reading a balance sheet? Is it
I think
like,
I would be doing a disservice, Akash. I'll be very honest. If I go into a 1.5 minute answer of doing this, I would request, to be honest, it's such an important topic that it's better to kind of learn it in detail from people about how to read a balance sheet. And there are enough resources out there to try and do that in a meaningful way. So I think I would be doing disservice, or anybody would be doing disservice, to be honest, if you get into a conversation about a minute and a half or two trying to explain to people what to look for in a balance sheet. I would urge you, let's not do that here.
Right. Okay. This is something that I use it myself. Like I look at management's intent, like what are they saying about growth forecasts? And you're the right person to ask this. What are the key things that you look at when you speak with all these CEOs? They are trying to run all these businesses. How do you read their intent by watching the interview if they are saying the same thing over and over again? And you also look at all these some things that you look at that on the financial metrics. Let's say somebody has evaluated a company and they check all those boxes. The last point that you need to look at is the management's intent. Like, is this management clean? And they watch all these interviews, you or all the other guys that are interviewing all these people. So how do you understand this management is clean and they are actually going to deliver on their promises? What are the things that you need to look at?
Well, I think the past history tells you a lot of things about that. I heard you when you said that the management is saying things over and over. If a management is not being completely honest about it, about the things and the intent, at some point of time it shows up. Sure, it could be too late for you by then, but I think in cases, a bit of past history of what the company's always done tells you enough and more about how much to believe. And there are various businesses out there. I won't name anybody, but we know of various groups, various businesses wherein it's difficult for the market to believe in what the management is saying unless the execution is done and dusted, right? And such groups always get lower valuations. So you're taking a risk if you believe such companies. And in certain cases, there are people who are very, very honest. And now the market kind of reads into this thing very, very efficiently. Those companies enjoy higher multiples. They've enjoyed higher multiples for ages. And you know that in the past, whenever they've made a mistake, for example, they've come forward and said that, hey, we made this mistake, but we are putting up our hand and saying that it was an error from our end. We're not going to do it again. Or, hey, that we made this mistake, but we learned from it. And this is what we are going to do. But there are some who give some very silly reasons, at times. And nowadays people are sharks. Con calls are filled with, yes, some very silly questions, but some fairly intelligent questions as well. And in certain cases, my peers in other places or my colleagues in my own platform try and quiz them in more ways than one to try and do that. So usually the history tells you a thing or two about how much to believe and how much not to.
Yeah. And a lot of time we hear all these managements, they come on TV channels, they are very optimistic. We get carried away with their high energy, and in a way that we understand it later that that was just one of the like ways to improve the market sentiments. But it is our actually, we have to take accountability of that decision, that we made that decision of investing and it went wrong.
Yeah, you do. And therefore the simple solution, Akash, that one, do you know a little bit about the cycle and the business? And if so, when the management is saying, ask yourself how confident you are to be able to verify what they have said, right? In some sense, that does it tally with what other industry people are saying? And if
Yeah.
the answer is all ticks box, then you bet the house on it. Otherwise, don't bet the house on it. If you bet a small quantity, you stand the chance of going wrong, but the mistake won't be too expensive.
Yeah, that's true. Okay, something that's very trending in the market right now, and it's also very trending in the retail segment, is algo trading. People they don't have too much experience of the markets, but they hear people talking about, hey, you should learn about algo trading before you get into the markets because it's going to be the next big thing. And we've seen a lot of volume on the NSE. I'm not sure of the exact number, but I think it's 70-80% comes from algo desks. Is it something that people should be focusing on when they're trying to invest or trade in the stock markets, or is it something that they need to look at later once they have enough experience of the markets?
So, Akash, at the outset, I confess ignorance about this topic per se. But and I know machines are out there. People are making money out of it. I've heard of enough number of people who set up investing platforms which support your mission to become an algo trader in order to make skim 3, 4, 5% every month, what have you, whatever the numbers statistics are. Some of those are very dodgy, by the way. I've seen there was a platform, I won't name it, but I was looking at it at the behest of somebody else who showed me that they've built a platform which allows people to keep subscribers on algos. And the first page itself, the 20th person who was offering these services had just one subscriber. So it might pay to be careful when it comes to some of these things, but there are some people who are masters of this game and they know it well.
Just a follow-up statement on that. Like, even I have tested algo desks, and I don't think that they are too much that I need to look at. I don't invest a lot, but whatever I do, I can do it. Like, I don't even need to actively participate in the market. All I need is, like, you need to put in some hours after you're done with your job or your business, and you just need to execute that trade in terms of on the next day. You don't need to have too much like, you don't need to put in too much effort in terms of, if you're not a day trader, of course. Like, if you're a day trader, you need to look at it. I'm not a day trader, but the returns are almost similar that I've experienced when I was using the algo desks and the whatever strategy that I have right now. So for me, it hasn't had too much difference. My capital is not that big, of course, but for somebody who is just entering, I'm sure your capital wouldn't be too much. So yeah, that's my POV. Uh, Neeraj,
Thanks,
one,
Akash. I didn't know about this, so it's good to hear about this as well. Maybe someday we will talk to you about algo trading.
yeah, absolutely. Neeraj, one more question on this. I mean, this is obviously one of the biggest questions that you could answer. Like, can you talk about what is your point of view on portfolio diversification and construction? Like, because a large part of your investing returns would come from the final decision that you make in terms of allocation. What should be the ideal allocation according to you when it comes to investing?
Uh, Akash, the simple answer, it actually depends on what kind of investor you are. Now, if you're an investor who can live with large drawdowns because you have the ability to be able to time cycles in a sector better, then by all means go out and have a concentrated portfolio. But there's something that um, that I don't remember who, but there's somebody who told me a very interesting of late that. With the number of things and the number of cues that are hitting you every single day on sectors, on market, on economy, on geopolitics, it might be better not to be too concentrated and keep it a bit more diversified, so that if your sector or the market at large gets hit by an unknown item, it doesn't hurt your portfolio too much.
Yeah.
More the number of variables impacting the market, sure, higher the probability of there being gyrations. And if your concentrated bet kind of gets caught in a quagmire, it could be difficult. But if you know the space very well, then sure. But just a leaf to the previous answer that I gave, Akash, some of the best guys that I speak to tell me that they do not have more than 15% in a stock, at times only 10%. That gives you an idea that these are high quality investors who understand cycle, who have a team of analysts supporting them, and still they have at least 10 stocks in their portfolio, at times more than that. So
yeah,
maybe that gives an answer.
right. Okay, let's like make it a little more clear. I'll give you a few themes. Let's say this is, for example, by the way, they're not like we don't have to follow this, but just to give them idea how we think when it comes to investing, when it comes to portfolio diversification. Let's have selected 5 sectors: IT, pharma, BFSI, banking, then there's FMCG, and let's say steel or infra. How do you diversify in all those 5 themes?
Infra is cyclical. You cannot have too much of concentration there, right? So you got to be mindful of that. Currently, it is doing really well, so it's an up cycle. So maybe you take advantage of that and keep a slightly higher allocation. IT went through a bit of a issue. I hear most people telling that at some point of time in the next 6 months, this could change dramatically. Companies are winning orders. So maybe the good part of the IT cycle as well as the pharma cycle is up ahead of us. So maybe that's a good one. FMCG. So I mean, yeah, maybe from here on, maybe a higher allocation to IT and pharma. FMCG is a bit of a tricky one in that inflationary expectations are still not coming down. You don't know how much of growth could come in. These companies are not cheap under any stretch of imagination. So you've got to be careful with your allocation there. What is the 5th sector that you told me? Steel.
Steel.
The companies are very confident of demand. If Indian infrastructure demand is going to grow, which looks very likely, and if you are believing in the infrastructure cycle, then you've got to believe in steel offtake as well. The joker in the pack out there is China. If China decides to stimulate, then steel prices inch up. I would reckon sentiment around steel stocks also inches up. But if you just hear the commentary from the steel companies, they are very constructive. Maybe not a bad bet. But again, this is all that I'm picking up from conversations with fund managers as well as from companies. I do not have an individual view per se of any of the companies or whatever.
That makes sense. Okay. One last question, Niraj, before we wrap up this podcast, and this is just for my understanding. You speak with a lot of people, a lot of influential market veterans. You have you speak to a lot of retail investors as well when it comes to your social media. There is an increased, I mean, I'm imagining there's an increased pressure when you talk about stocks or sectors, because somebody out there would be making financial decisions based on your research. First, do you feel that pressure? Because I'll tell you why I asked this. Like, I make content on stock markets, although I don't talk about individual stocks. I only share my experiences, what I'm doing. I kind of feel that increasing pressure that I shouldn't be talking about this thing. I shouldn't be talking about, even though I have to just share a case study of something that I've done. I feel that increased pressure that somebody might make a financial decision based on my research, and I don't want to hurt their hard-earned money. Do you feel that stress, and how do you cope with it?
Yes, I do, and therefore the standard way to do it is through a disclaimer. No, but I hear you. I mean, disclaimer is one thing. It just protects the person who is giving out the recommendation, if you will. But as a responsible journalist, Aakash, so the last 5-6 years we've shied away from doing any kind of stock talk on my shows. Largely, we in fact discourage it, because you are right. The thing that Ramesh Damani, for example, taught me via various shows that I've done with him in person on location. is that if you talk, let's say Akash, you were, and I'm sure you're a successful investor, but let's say you were a very large investor and people followed you in droves and people would buy a stock when you even speak about it. The problem is, in all good faith, you've spoken about it, and then people have bought it and you've exited because the story turned, but they don't know this, and therefore they will be caught left holding the bag. So yes, there is pressure, and therefore the simplest way to try and do it is try and encourage people as much as we can to do their own research, and which is what I think, Akash, through this podcast we've tried to say that as well, right?
Yes.
That you need to know both the art and the science, and while science is known, the art is as important. So do your own research. Do not follow an investor just because she or he have bought or invested in a stock. When they get out of it, it is not their responsibility to tell you that they've gotten out of it, and they are not responsible also, right? So you will curse the investor at the end. "ये साला खुद निकल गया, लेकिन मेरे को नहीं बोला." But he's not meant
Yes.
to tell you all of that, right? And you will be left holding the bag. So why do you want to enter into that kind of thing? So try and which again goes back to the first point, or the initial points that we made, Akash. Sorry, I'll just take 30 more seconds here. That if you understand the business cycle, if you understand all of those things, then go out. And if you can give time, then go out and be a single stock investor. If you can't give time to this is a full-time profession. If you can't give time because you have a job or you have a profession or you have a business, then don't try and do this. Even if you don't do mutual funds, and if you still want to do single stocks, don't try and bet the house, or don't try and buy large quantities just because you heard a really smart investor talk about a stock on television. When that investor gets out is not something that you would ever know.
Perfect answer. Something that I've always talked about. Thank you so much for your time, Niraj. Any last few thoughts that you'd like to share with your audience? Somebody who is trying to learn from you, including myself. I watched a lot of your interviews. I've learned a lot about stock markets from your interviews, how you have interacted with people, investors. Any last few thoughts that you'd like to share with your audience?
No, when we started this platform, which is now BQ Prime in 2017, Akash, our goal, me and my CEO were discussing that our goal is to make 1 million millionaires. I think India has already done that, and I think we are on our way to probably do much more than that over the course of the next few years, ceteris paribus, all things remaining good. So it might help investors to who are investing in India, of course, that's the populace that we're talking about, to try and believe in this story. But as much as you believe in the story, to try and not get carried away, try and do homework. Don't invest large sums of money on tips that you received from anonymous people or on TV or otherwise, and protect your downsides at all costs. It's important to stay in the game, and that you can only do if you can protect your downsides. It'll be really bad for India as an economy to be where it is, or like I've written in an article, Ab ki baar Nifty 50,000, that Nifty will be at 50,000, but you would not have participated in it because you incurred a heavy loss due to a tip that you followed and bet your whole house on it. So just be careful of those few simple things. Give this a little bit of time. If you don't have time, get an expert advice. But this seems to be a turn which could actually create a lot of wealth, and Indian retail investors should participate in it.
Amazing advice. Thank you so much for your time, Niraj. This was an amazing podcast. I hope people find value from it. I hope people email you after 5 years thanking you that you helped them start their investing journey. I mean, I look forward to that. Thank you so much for your time, Niraj.
Cross all fingers, and thanks to you for doing such a wonderful work, Akash. I loved being here. Thank you so much.
Thank you. Thank you. Thank you for your time. Take care.
Thank you.